Hello, everybody. Chad Lubin, Cross Country Mortgage. I hope your home search is going well. If you're out looking for homes, I hope your start of summer's been great. I wanted to just give some information to dispel some of the misinformation out there in the media right now. I always say follow the experts. I have a finance degree. I have a basic economics background. I've been in mortgages for 20 years. I've consistently been in the top 200 for loan origination. I'm a national coach for mortgage lenders. So I'm not just someone spitting information out there and have a lot of great resources to get this information. So some of the misinformation out there is right now, interest rates are going to go up, demand is going to go down. That is true. A little bit of demand will go down. A recession is upon us. That means home prices are going to go backwards. That's not necessarily true. There's been 13 recessions in our country since 1960. I went back to 1960 and done the research. 12 out of 13 of them, home prices did not sharply decline. It only happened once. That was 2007, and that was the recession caused by the housing industry. This recession has not been caused by the housing industry. This recession has been caused by supply chain issues, by our government printing money it didn't have and pumping it out, and a little bit of a pullback from COVID. So those are kind of the perfect storm for the inflation pressures we have. But I wanted to talk to you today about simple supply and demand. These are basic economic principles right now that our country is facing. So I'm going to share my screen here with you. So supply versus demand in housing, right? If we look at current household formations, these are new households being created. So the millennials are the biggest generation since the baby boomers, okay? They have graduated college. They are starting to get married. They're starting to have kids. That's a new household formation. So we are above average right now. Here's where we're at currently. It's 1.4 million households created so far this year. What is average? A little bit below that, closer to the 1 million mark. So we are above average in new households being created. So that's causing demand. Cool. New supply. So we have about 1.7 million housing starts. That's the data that most people go to look at. Is these are new permits, houses being built. So a permit to build a new home is what housing starts are at. That's 1.7 million. There's about 100,000 homes destroyed annually. So that puts us at 1.6 million new households or new supply created. New housing demand. Remember, I just told you right now, it's currently about 1.4 million. That's the new household formations. Think new marriages, right? Think people moving out of their parents' house and moving into a home. Think divorce, right? And if a husband and wife get a divorce, the husband goes and buys a house, the ex-wife goes and buys a house. That's a new household formation. So that's about 1.4 million. So it looks like on the surface that we have a surplus, which means we wouldn't have an inventory challenge. But when you really dig into the number, housing starts completed, just because they're started, right, doesn't mean they'll be completed this year. There is supply chain issues, right? There are permits that might not, they might not move forward with in the construction. So the actual housing starts completed is the number we want to look at. And I think a lot of the media gets this wrong and gets this math wrong. So when we look at completed households, that's 1.3 million. So if we take away the 100,000 households destroyed, we're at 1.2 million in total new supply, right? Now, remember, we have 1.4 households being formed this year. So that gives us a deficit of 200,000 homes, right? So we're not working at a surplus, which the surface level numbers look like. We are working at a deficit. So now, what is our inventory? Our inventory, if you look back, this is to 2008, we were beginning of 2017 into 2018, we had record inventory of about 2 million. Okay. Now there's a drop and then there's a surplus. There's a drop and then there's a surplus. Guess what those times are? What's right at the end of 2018? That's right, winter. And people aren't putting their homes on the market in the winter like they do during the spring, right? So yes, we have seen more inventory come to the market. But if you look, and you'll hear the media misinform, and they'll just go with the current and not look at history, right? Well, yeah, every year there's more household inventory in the spring and summer than there is during the winter. So they construe the numbers to get out their fear and peddle their fear. So check it out. Yes, we have more inventory. So we have about a little over 1 million households in our country right on the market right now. But if you look back, right, that's record lows, right? 2021, we had about the same. 2020, we had more inventory, 19. So it's still way below average when you look at this. So check out the existing home inventory. Here's the real story, right? So we have existing homes of about 1 million, right? There's about 1 million homes currently listed, right? Now, everyone thinks, oh, we're really close. There's 1 million homes on the market. There's 1.4 million household forms. So we're only about $400,000 short, 400,000 short. But you got to subtract the market or the properties that are under contract. They're off the market. They're contingent. They've already been sold. So when you look at that, the actual active listings across our entire country right now are 400,000, right? So if you look back to 2017, right, there was 1.55 million, but the market inventory, 75% of those were available. So they weren't going under contract quickly, right? So I just want to drive this point home. If you look at this $400,000 actual 400,000 actual home inventory, right? To right now, only 40% in April of last year were available. So we have 35% less homes available while they're on the market. That means they're getting gobbled up right away. So you've seen this if you've been out looking for a home, right? We're only 33,000 homes available from our lowest inventory ever, right? These are with these higher rates. So yes, there has been less demand with the higher interest rate, but we're still very close to record low inventory. So that's what's causing this supply and demand issue. There's just not enough supply to meet the current demand. Now, the last part of this is vacancy factors, right? Before, if you look back to 2006, people were just offloading because they had a vacancy, and their carrying costs were so high, right? Now, currently, we have less than 80, this is less than 1% of our homes nationally, 80 basis points. It's less than 1%. So it's 0.8% of 1% that have vacancy. So when you put all these things together, you can just see that our population growth with new households formed, with the baby boomers condensing their homes, right, and needing different housing for aging, and the new biggest generation, the millennials, coming and forming homes. We just have this inventory challenge that will stand out there. So yes, the market has slowed down. due to higher interest rates. That does not mean we're going backwards. People get this wrong all the time. Just because appreciation has slowed down doesn't mean that we're going backwards. It doesn't mean values are going backwards. There's still this near record demand for a near record low supply. So I'll continue to monitor this with you. You are much more likely to get a home under contract right now than you were at the beginning of the year and definitely last year. So stay the course. Remember, you're renting the money, okay? You will refinance. I believe that will be in the next 2 years. The Fed is going to raise the prime rate way up. Inflation is going to continue to cause mortgage rates to go up. They will eventually get it under control. I believe once they do, it will start a global recession. And just like they did during the financial crisis, just like they did during COVID, just like they did in 2014, they will stimulate the real estate industry by purchasing mortgage bonds. It's called quantitative easing, and these mortgage rates will pull back and we will get you refinanced. So that's truly what I believe will happen. I am here to support you through all this. Stay the course, continue to look for homes. I believe the prices are going to continue to go up, not at the rapid pace they were before. I believe we're towards the top of where interest rates will be. I can see them capping out about 7. You're seeing in the mid 6% range on most interest rates right now, and then they'll pull back. So make sure that you know your options. I think a fixed rate, adjustable rate mortgage. So fixed term adjustable rate mortgages, you can lock in a rate for 5 years. You can lock in a rate for 7 years. You can lock in a rate for 10 years. I'm telling you, within 7 years, we're going to be refinancing. And that's the time you catch the fixed rate. That's the time you go to the 15-year fixed when we have an interest rate cycle lower. So I'm here to advise, support, and to give you everything you need to make this decision. I'm honored to be working with you. And please give us a call if you have any questions on this topic or anything else. 312-731-4939. Thank you for taking the time to watch this video today.